Hi, Jonathan York, Bay Financial Partners, looking at investment markets. Almost a case of sort of be careful what you wish for. Certainly the markets were looking for the Fed to cut interest rates. They did. It was just a quarter point. But more interestingly was the sort of commentary that accompanied it, when the fact that maybe this was sort of viewed as certainly from the Fed's perspective, as a sort of mid-policy adjustment. That sort of ruled out potentially further rate cuts. They weren't guaranteed, and obviously you still be data dependent. Now, if you look at the data, certainly from the US, you've got a pretty strong economy, you've got record low unemployment. Yes, you've got inflation that is undershooting the sort of 2% target, but it's been undershooting that for quite a while now. You've got pretty strong earnings coming through from corporates, as been shown in the recent earnings season. And obviously, I suppose, the big question mark will be sort of, President Trump, his ongoing trade spat with China, and that's going to impact on companies, but also as well sort of consumer confidence and growth going forward, especially as we head into the election year. So, sort of quite interesting to see how it's going to sort of play through. Will we still see a further cut before year end? Many analysts were predicting yes before this Fed meeting. On the back of it now, potentially not. So really data dependent. Earnings are pretty strong, has been shown by certainly some of the big corporates out there. Apple was a pretty good beat as well, and that was quite interesting because if the stock had been sort of marked down and was sort of really on a hiding to nothing, really, a lot of people were expecting low earnings, especially coming out of China with their iPhone sales. So now certainly all eyes turn to the employment data coming out on Friday US time, and it'll just be interesting to see how that sort of goes. Certainly last time was a lot stronger than anticipated. Expecting 166,000 jobs to be created. That's versus 224,000 last month. No particularly good start for Boris Johnson, sort of taking over as UK PM. Has really been pretty sort of hard and fast on the sort of Brexit. It will be sort of fill or kill. It'll be on his terms, or they'll come out with a no deal. That really hasn't sort of inspired the markets. British pound trading down at its lowest levels in 2 years. Confidence is low as well, and really he just sort of comes across as sort of bumbling along and not really having much idea. Certainly it is a fresh prime minister, but really you still got the same issues there, and his sort of plans to put forward to the EU have been rejected pretty much almost before they've got through the door. The problem is that he sort of backed himself into a corner that come October the 31st he will be out. If there's not a deal on the table, he will take the UK out without a deal. That has some pretty major implications out there for the UK economy. Interesting piece coming out from one of the major Australian banks. They're projecting the interest rates in Australia by sort of mid-2020. The official cash rate will be down to 0.5%. Now again, that has some pretty major implications out there for savers, for bond rates, but also as well for equity markets as well. Likewise, that same bank predicted rates in New Zealand by sort of mid-2020 will be down to 1%. Currently the OCR is 1.5, and obviously taking interest rates down to 1%. It certainly would sort of underpin the housing market because mortgage rates would be still pretty cheap. Borrowing had never been cheaper. But obviously the flip side is, for savers and term deposits and bond rates, they're obviously going to fall. That's maybe being backed up by the latest sort of consumer confidence out there, business confidence, again falling and showing really little signs of sort of picking up. Potentially the bank is maybe just trying to sort of cushion that blow, cutting interest rates, making borrowing cheaper, trying to stimulate the economy. Now, certainly lower rates, I'd say, will underpin the housing market, and that should give a little bit of confidence out there to the consumer. But obviously bond rates will then fall, saving rates will fall on term deposits. And for people looking for income, especially retirees, it's a pretty tough place out there. That's why a lot of the high dividend shares and the sort of defensive stocks, the sort of power companies, etc., have really had a pretty decent bid this year. Coming down, some of the property trusts now are still up around sort of 10, 12% in terms of capital prices on the year, but also still giving you about just over a 4% net return in terms of income. Now you compare that with the term deposit that is probably lucky at 3% if you're lucky, and that's gross. A lot of hype out there. The Napier Port IPO, it's going to be pretty highly sought after. The price range for the shares is sort of 227 to 260. I suspect, given the sort of high demand that will take place for it, it will come in at the upper end of that range. I think they'll be pretty heavily scaled as well. But if you're interested in participating in that IPO, call us on 0800 867 323. So if you are looking for income options, there are plenty of alternatives available out there. Call us on 0800 867 323 or go to the website www.bayfinancialpartners.co.nz for lots of interesting articles. And we look forward to speaking to you soon.